Hi, this is Steve Erdman with International Futures Group and EFG Group of Chicago, Illinois. We're coming to you today with a chart look on the crude oil market. I'd like to go to the chart right now so you can see what I'm seeing in this price pattern. This is a 10-year chart of a weekly crude oil. Every bar in this chart is 1 week's price action. And if you see, going back to March of 2005, we've had quite a bit of volatility in this crude oil market. You see the highs we made in July of 2008 at 147.27, and the market dove into early 2009 and made lows at 32.48. And then we had the subsequent rally into 2011 to make the May 2011 high of 114.83. But what I want you to gather most from this crude oil chart is the pattern that we've been in since that May 2011 high for the last 4 years. I've drawn some horizontal lines for you to gauge where I think the crude oil market is finding support as we speak. You look at the week of August 30th high of 2013 at 112.24 and the previous low from the week of June 29th at 77.28. If you flip that channel over, it measures to an ultimate measured target of 43.32, which is just pretty basic math. 112.24 minus 77.28 gives us a target of this formation that we've had for the last 4 years of 43.32 again. The actual low in the week of January 30th in this past 45 days was 43.58. Now, whether that low is the ultimate low or not, I don't know, obviously, but it seems to me that that gives us enough reason to be looking at strategies that may want to buy crude oil. I've got targets. If you look at the circles that I've drawn on this chart, there's 4 circles drawn on the chart. I want you to look at the circle furthest to the left, which is the April 2009 low of 43.83. That's another reason for support in this area that we found in late January. And that the circle just to the right of that in the July high of 73.38. That's what I think is a reasonable target for this formation and for this pattern that we're viewing at this point. So I'd like to suggest a number of strategies that you could consider. You could go in and put calendar spreads on by selling May crude oil 43 puts, or approximately $500 a piece, and buying July 73 calls that are also approximately $500 a piece. Again, that's called a calendar spread. You could buy our suggested target that I just shared with you of that $73 area by buying $73 calls for $500 a piece. Again, that's a July option. That gives you a decent amount of time for something to develop in the crude oil market. I would caution you, if you take the first strategy, the calendar spread, you want to risk about half the premium you collected on those 43 puts, because that could be a risky position if the market continued to drive lower and try to achieve the lows that we made back in late 2008 of that 32.50 area. That's not my belief, but that very much could happen. I also want to point out, since the beginning of 2015, we've made what I consider a V-bottom in this crude oil chart. And I like V-bottoms. I like the dynamics of this formation. I like the fact that in the last 5 weeks, we kind of retested that low, or the market acted like it was resuming its downtrend. And to me, that's a head fake. It loads people up on the short side again. And if the market is able to come out of this V formation and rally over these highs that we made the week of February 6th at 54.24, the week of February 13 at 53.99, and the week of February 20th at 54.15, and we get a weekly close over these levels, it will indicate some confirmation that the market, at least in the intermediate term trend, has changed and the market's ready to rally a little bit. So hopefully some of these strategies that we presented to you in this view of this crude oil weekly chart, 10-year chart, have helped you, and we'd love to hear any questions or strategies that you might want to consider.